Good afternoon, traders and investors. Will back here with another one, coming to you with a Friday and weekly market recap. Hopefully you all had a very good start to the weekend so far. And in Friday's markets, guys, well, we've officially made it into the history books once again. The last 2 days of selling are some of the worst days of selling that you can possibly find in the history of the stock markets overall. Take a look at this. The last 2 days of selling culmination in a 10.5% drop-off in the S&P 500 have only been bested by days in 2008, 2020, and 1987. So that is a very, very negative event for the markets overall, but I'm pretty sure you've seen a number of different headlines like this. In terms of the Friday percentage day decline, well, unfortunately, it did not make the list of the top 1 day percentage drops. It was only about number 25, so it's not even on this list, unfortunately. A few days in 2008 and 2020 did make that list, but however, in terms of largest daily point losses, the last 2 days have been the number 2 and 3 largest point drops in the history of the S&P 500. That is very simple because now the S&P 500 is trading at a whole lot of points, right? We're trading at about 5,500. So it makes sense that any 4, 5, 6% drops are going to be a lot bigger in terms of point drops than they would have been otherwise in prior markets when the S&P 500 had a lot lower of a point basis to go off of. But I'm pretty sure you guys have seen the headline so far. The Friday drop was the China retaliation day when China imposed 34% reciprocal tariffs on imports of US goods and also putting several restrictions on critical minerals. That is arguably the more important part of the news because those critical minerals are used in anything from production from magnets, electronics, and even some defense capacities as well in terms of missiles, gunpowder, and a whole host of other things that the United States really needs. And that left the markets extremely weak into some form of a liquidation frenzy in the late hours of the Friday afternoon session. So in today's video, guys, I'm not going to present you with a bunch of historical headlines or stuff like that. We are going to go through a ton of charts and try to make sense of the technical analysis throughout everything. The first portion of the video will be dedicated to just a really easy news recap from the Friday event. And then I'll also present you a video that came out on Friday from one of my and even Warren Buffett's favorite personalities in the investing world of all time, Mr. Howard Marks himself, legendary bond investor. Warren Buffett has looked up to Howard Marks almost the entire time that they've had a career amidst the same times since the 1970s and the 1980s because his takes are really always objective, based in fact, and he does not like giving macro predictions at all. So we'll take a quick look at the news headlines, then a quick little snippet from the video from Howard Marks in a Bloomberg interview. Thereafter, we will do a technical analysis rundown, guys, of all the major indexes, see how we are shaping up. Are we oversold and by how much? Is it a buy the dip opportunity for a long-term portfolio? And what should we possibly be doing with our trading portfolios as well? Thereafter, we'll take a look at our big tech names because big tech got absolutely washed on the Friday and even Thursday sessions. Big tech has come down a lot since the highs, but are they currently at good valuations in an objective manner, or might we have to be a little bit prudent heading into their own respective earnings season coming up in just 2-3 short weeks of time, keeping in mind that we still do not have any retaliation from the European Union, who might just retaliate on some of these big tech companies, which is arguably the biggest pain point that they could pinch on the US markets overall, right? So that is going to be the focus of the video today. And to wrap it all off, we will take a look at my portfolios. Yes, my portfolios, plural. So of course, Friday was a very bad day. And just a quick preview, guys. In the trading portfolio, I sold absolutely everything, but it's not what you think. It's a reposition sell, not a panic sell at the bottom, switching up the strategies from the either bullish or sideways market strategy to the pure form bear market strategy overall. In terms of the long-term portfolio, I've been very vocal about that too, guys. We're not selling. We're never selling the long-term portfolio. We're in it for the next 5, 10, 15, 20 years, and probably you should be as well. The long-term portfolio, though, has taken a hit, currently standing at about $423,000, down from the peak early February of $535. So if you guys are down money, don't worry, I'm down a lot of money as well, and we will make it through this one together overall. So we'll be doing a quick recap of the portfolios at the end of the video, both the trading portfolio, in which I will give you my current strategy moving forward, and also the long-term portfolio outlooks as well. So should be a very fun video, guys. Let's jump right into it, shall we? So the SPY down 5.85% on the Friday session. The QQQs down 6.21%, and you could not find any safety in the markets. prior to the last few days, even on Thursday, the announcement of the US tariffs, you could find some rotation. On Friday, you could not. Big liquidation event, just pure fear engulfing the markets. This entire list of sectors was red. Even gold was red overall. There was absolutely no safety to be had in the markets either. And if you take a look, guys, Europe, that was not a safety trade, down 6.5. You could look at the even some of the Japanese markets, such as the Nikkei. The Nikkei, definitely not a safe haven trade as well. And even respective to the Chinese market, guys, even Chinese market, I know this is not their S&P 500, but if you look at an ETF like KWEB was also down 9.4%. Everybody getting hit unilaterally across the board, which gives us a heat map that looked like this. One of the worst heat maps that I've seen in a very long time, guys. This weekly drop on the SPY and QQQ, the SPY down almost over 10%, the Q's down well over 10% in a week. You would have to go back to the pandemic or 2008 to find similar weeks like this. So the heat map, quite brutal. No names except for a few tiny names, home builders and Nike making it out alive, but everything absolutely heading a lot to the downside overall. The banks, healthcare, absolutely everything, even your defensive sectors. In terms of the one-day relative performance, you can see that even better. Multi-percentage drops well across the board. Energy getting hit as it kind of tries to price in the possibility of a recession. Several banks now putting the possibility of a recession at 50, 60%, or even higher. JP Morgan came out and said over the weekend that they now expect a recession. It's not even a question of probability. That is their normal case scenario overall. Taking a look at the fear and greed index as well, it has hit a very low read of 4. So can we possibly be seeing some relief rallies in the market come next week? Yes, absolutely. But will those relief rallies last? Or will they just result in lower highs before possibly just edging further towards our lows? That's what we'll take a look at in today's video as well. So before we get into more technical analysis here, guys, let us dive into some of the news headlines that happened just last week. So of course, we went over the big one in the intro, which was the 34% reciprocal tariffs on imports of the US goods in retaliation to Trump's tariffs of his own. Now, we're not going to go into a deep dive of, the economics and the impacts of tariffs. We did that on the Thursday video. I highly suggest watching that video. The first 15-20 minutes are dedicated to an analysis of tariffs, who it affects, and why, who can be better off from it in the short, medium, and long term, and how it affects both the home country, the United States, and other countries alike. We're just going to look at the headline. This was the big piece of the news. Now, since that news came out, we did have some relief negotiations to be had over the past few days. Vietnam has been offering a 0% tax on US imports, and Cambodia has cut theirs to around 5%. Now, as well, Trump has spoken with India, Vietnam, and Israel. Vietnam is still on the table. There was a phone call on Friday where Vietnam offered to cut their rates to 0, but still no official statement of that having happened already. India is now in negotiations. Israel is now in negotiations as well. So keeping that in mind, with those new news headlines, well, the markets now officially, the QQQs have entered a bear market, which by definition is a pullback from the highs of over 20%, now 21.8%. The SPY, not there just yet. The SPY is almost there at about 18%. Few more days like this, and you will definitely be in a bear market. So how long do bear markets last overall? Well, take a look at this table right here. You can see that these are all the bear markets since 1929. Their respective percentage declines. As you can see that many of them are actually in the high 20% to plus 30% from top to bottom drops. And many of them, some of them last in the 60 to 90 day range, but you can see that most of them are triple digit days in terms of bear markets, meaning 6 months or more. Your average decline across all of those different bear markets was 35% to the downside on the S&P 500 and an average length of 289 days. Now, we do not know how long this one is going to last. No one knows because there are far too many implications, both geopolitically and home in terms of growth concerns about the US economy. Keep in mind, the hard data has still not rolled over. The jobs are still relatively healthy. We got more of those on the Friday session, and it did not help, guys. Even Trump's phone call with Vietnam temporarily provided some relief for the market, but then was washed away with the end of day selling as well. The non-farm payrolls, which came out on the Friday session, came out at 230,000 jobs. Keep in mind, though, this may be one of the last good jobs reports that we can possibly get in the near-term future before the Doge government cuts come into play and possibly we start seeing corporate layoffs due to the uncertainty of the macro conditions right now. And even this very good report, as we've said many times over the last week, The market at this point doesn't care. It didn't care about Jerome Powell being bullish on the FOMC about 2 weeks ago. It didn't care about relatively muted CPI results. And now it doesn't even care about a couple of things, right? It did not care this week about the ADP employment change, private employment. It did not even care about the non-farm payrolls. The only thing the market cares about right now is the current narrative at hand. It is the forward-looking data as a result of these tariffs that have been put into place. Now, of course, on a long-term time horizon, guys, we have to look at the big picture. Now, this has to be there has to be a definition made between whether you are looking at the markets from a short-term swing trading perspective or if you have a long-term investing perspective. And for the long-term investing perspective, it's very clear. Don't take it from me, take it from billionaire investors who have come before me. It's never a good time to try and time the market with a bulk of your portfolio in terms of getting into the market, getting out of the market with your long-term portfolio, talking about positions that you plan to be holding for the next 5, 10, 15, 20, 25 years. Therein comes a DCA approach, but you do you. If you don't want to be in the markets and you want to be part of the people who just want to sell everything because it makes you feel psychologically better, maybe you have an opinion that the markets can drop significantly lower, I will not stop you. But the statistics do paint a very clear picture that we should stay invested in the markets. I can bring you statistics like, if you miss the top 10 best days of the market, your returns are going to be this. If you try and time the market with long-term investments, your investments would be this instead of this. But I think you guys all know that literature by now, yeah? Here's the one thing that you have to remember. The tariffs that are put in place right now are some of the largest tariffs that have ever been had across any markets overall. Here is the estimated amount with the tariff announcement from the other day. These, you would have to go back to 1861. It's not even on this chart to find tariff levels that were this elevated overall. So definitely it's a condition in the market right now that none of us, absolutely none of us alive for the most part, have ever seen unless you've been alive since 1861. The last time tariffs were almost this high was in the 1930s. And you guys know what happened after those tariffs were put in place in the 1930s. It led to something known as the Great Depression. I'm not saying it's going to lead to that this time around, but that is the last point of context that we possibly have in the current markets right now. So if we wanted to take things in context of investing during a bear market and why it's always a decent proposition, you can look back at a chart like this that goes back all the way to 1961. We can clearly see that in terms of recessions and drops, well, the bear markets are a lot shorter in terms of cycles, even the longest ones, than the actual bull market expansions are. And usually you have a lot more long-term duration expansion. And also in terms of percentage points, the markets tend to expand a lot more than they ever have contracted. That's been true for every single correction since the 1960s. So the data points to the fact that we should stay invested in the long term, and we should also be contributing new money, especially if we have paychecks regularly being deployed into the markets. The recipe is very simple. Keep your expenses lower than your income and invest the difference in very high quality assets overall, whether that be real estate or whether that be a high level of, or rather a high quality suite of ETFs or even individual names alike. Not telling you guys to full port Palantir right now is essentially what I'm saying. It's always been a good proposition, and you can look at that coming back from the SPY. I'm pretty sure many of you would have loved to buy at any point, not trying to time the market, but you would have loved to buy at any point during the 2022 correction. You would have probably loved to buy at any point during the COVID-style correction, the 2018 tariffs, round one with President Trump, and even during the 2008 correction. You would have loved to buy at any point. Sure, you would always love to buy the bottom. Everyone would love to buy the bottom. But it's very tough to time the bottom when the bottom only comes in when certain things of the current narrative changes. The bottom of the housing market was in for different reasons than the bottom of the COVID market was in specifically, right? We can talk about that at a different time, but just letting you know, every one of these bear markets has different catalysts for this start and for the finish as well. But the point is always the same. Even during 2001, you would have loved to buy at any point during the bear market correction. Now, some of you can talk about the lost decade, to where if you would have bought here, you would have just made your money back, then get shot down again, and only made all your money back in, in 10 years pretty much. However, that's if you're deploying one single lump sum. If you're always DCAing throughout the correction overall, then your chances of making it out with far greater returns at the end of a one bear market, a double bear market within the next 10 years are a lot higher, which is why we cannot time the market with one large sum of money overall. We should be buying our favorite companies or ETFs all the way down overall, guys. And I'll reiterate, right? The only way that you could possibly do that is by minimizing your expenses, maximizing your income, and investing the difference accordingly, right? So that is your quick, very little introduction in terms of these markets overall. Now let's dive directly into the technical analysis, because there's going to be a few key points of note here that we've been hinting on the past few weeks, but now we're going to be front and center for our analysis. But I forgot, before we do that, we have to listen to Mr. Howard Marks himself, guys. As I was saying, it's very difficult to predict the market cycle tops, the market cycle bottoms, and where exactly we should be deploying our capital, which is why a DCA approach is always best. In terms of stock, guys, all valuations are relative, right? Every single valuation in the books is relative right now. A stock, at the end of the day, is only worth what the market is willing to pay for it. So you might see me bring up names like Google, where the valuation of Google has been low for a very long time at this point. For the last 3 months, as a matter of fact, Google is now sitting at a 17, almost a 16 forward price to earnings. At face value, in a relative comparison, you can say, well, Google usually trades at a 25 to 30, and now it's cheap. But if nobody wants to buy Google, the stock price is not going to go up, and it can stay that way for a very long time. Stocks can stay extended away from their fair values for a very long time. Names like Palantir. Palantir has not been cheap, arguably, since the $30, $40 range. But this entire rally, nobody cares. So something can stay overbought and overvalued for a very long time, and people don't care. Well, similarly to the downside, names like Google can stay undervalued and unappreciated and cheap for a very long time as well, which is a bit of a head scratcher. And the poster child for names like that have been plagued by either nation-specific uncertainty or economic uncertainty as well, while still being fantastic companies and being cheap, is a name like Alibaba, right? Alibaba, I've covered this one a number of times since starting the channel. It was stuck at a low valuation of a forward price to earnings, guys. It was down here at 70. Now you cut this PE ratio in half, because we did the analysis at 135. At 70, 80 bucks, your forward price to earnings, I covered it many times over the last 2 years, the forward price to earnings was a 7 or 8. The PEG ratio was half of 1. It was a 0.5, and the free cash yield at that time was over 10%. They had a tremendous amount of cash on hand, a tremendous amount of buybacks, and the company was still growing extremely well. Very profitable company. The company has been growing for the last few years, but nobody cared. Nobody wanted to buy it, even in spite of its future growth prospects of EPS and revenue alike. Nobody wanted to buy it for its profitability either. This company has a tremendous amount of cash on the balance sheet. It always has never been a problem of debt nor free cash flow, but still nobody wanted to buy it. And you can find some examples more closer to home. You can look at a company like Square, which for the past 2-3 years has been stuck in a lower range at an extremely cheap valuation for its growth. But if nobody wants to buy it, well, then the stock price will not go up. You can say what you want about those companies, whether you like Square, whether you don't like Square, whether you like Alibaba, or whether you do not like Alibaba. One thing is for sure, if stocks can stay expensive for a very long time, they can also stay cheap for a very long time. If investors do not have the confidence to invest in that company specifically, or a certain sector specifically, or an entire market overall specifically, right? It not only goes with individual names, it goes with sectors, and it also goes with entire regions or entire economies. So that's why I say, in times of uncertainty where nobody knows the absolute outcome because there's too many factors at play, the US, the European Union, China, and the other Asian countries, how it's all going to play together, how long it's going to take to resolve, nobody knows. Will there be a recession? Will there not be a recession? You can have an opinion, but truly, if you say you have a crystal ball and you know exactly how much the market's going to drop, you know exactly whether or not there's going to be a recession, you know exactly how much people will be laid off or not laid off, nobody knows, guys. Those are just predictions, right? And predictions always have probabilities. And let's take a listen at what Mr. Howard Marks has to say about this himself, because he talks about that lack of clarity and how things can stay somewhat irrational for a very long time and may not just respect your predictions or the probabilities of your predictions, which is why predictions always need to be made with probabilities at hand, and sometimes even other people's predictions need to be taken with a grain of salt. Let's have a listen, shall we?
You've thrived during your 5-decade career, almost 5-decade career, during times of dislocation. Is this a time of dislocation to play or not to?
Well, it's a time of dislocation. Everybody has to judge for themselves whether the reduction in asset prices so far is right, inadequate, or excessive. If it's excessive, you should jump in with both feet. If it's inadequate, you should wait until things adjust further. And it's impossible to make that judgment qualitatively. You used the word measure before. I pushed back a little bit. There's no place you can look. There's no analysis you can do to determine whether today's asset prices are right for the environment ahead. Now, there never is. It's always conjecture. It's always guesswork. That's, in theory, why the greatest investors are great, because they make those judgments better than most people. It's excessively hard today because today we have no idea what the future is going to be. Normally, we think we know what's going to happen in the future. We normally assume the future will look mostly like the past. We extrapolate, and usually it works because the world doesn't change that much. But the world economy and the world order beyond economy, meaning geopolitics and international relationships, has been shook up like a snow globe by the events of the last days, and nobody knows what it's going to look like. Nobody knows. I dare say, if you tell me that what our rules will be 6 months from now, I'll bet you you're wrong. This is in flux. And if you think it's in flux, then by definition, you don't know what the future holds. And then even if you know what our country's going to do, and it's going to be that way 6 months from now, we don't know what other countries are going to do, what the ramifications will be. And so, I always inveigh against forecasting. I don't believe in macro forecasting, my own or other people's. And we know much less today than usual. Now, people who like to run their lives according to forecasts, they say, well, this is going to happen in the future, so I'm going to do this, and this is going to happen in the future, so I'm going to do that. What you really need, if you like to work with forecasts, is you need two things. Not just a forecast. You need the forecast, but you need an estimate of the probability that your forecast is correct. And today, whatever your forecast may be, you have to say, the probability that I'm right is lower than ever, because the probability that we know what the future is going to look like is lower than ever. And that's how I feel.
So there you have it from Mr. Howard Marks himself, right? So what he was saying was a number of different great points, which I really think do apply in these current market conditions, guys. As he was saying, in terms of asset prices, each and every one of you, not me, not somebody you listen to on CNBC, not Warren Buffett, no one can make that decision for you. You have to make the decision whether or not the asset prices right now are adequate or inadequate for the current macroeconomic conditions. Even though we don't know where the bottom is, we don't know where the recovery is going to be. Is the recovery in 1 week? Is it in 1 month? Is it in 6 months? Is it in 2, 3, or 5 years? Nobody knows, which is why each and every one of you have to make a determination. Which assets do you want to be invested in? And are those assets fairly priced, in your opinion, for the current market conditions? I gave you examples of Alibaba. I gave you examples of Google and even Square, to how asset prices, even though can be very cheap, can be going cheaper and can possibly stay down for a long time. So we need to assume the risk individually as to which assets we want to be invested in. Nobody has a correct answer on this, which is why you see so many, so many differences of opinion in any comment section wherever you look. Some people like to invest in gold. Some people like to invest in the S&P 500. Some people like to invest in individual companies. And you can make a case for all three. Some people want to sell everything and go absolutely short the market. That is their choice, guys. You cannot start to convince everybody of their own belief systems or what they believe asset prices should be. Everybody is working in a game of probabilities. There is no true pure laws in finance. The market is a equilibrium mechanism. It is a pure form based of supply and demand. As we said, right? Companies can stay cheap for a very long time. Their share prices will not go up unless there's more people buying the shares. than there are people selling the shares, and that is irrespective of a company's fundamentals. Now, of course, the cheaper that companies become, the better deals that they become as well if you have a long enough term time horizon, and if the company is constantly increasing revenue, EPS, free cash flow, and a number of other fundamental metrics. So that is the conclusion that we have to have about today's markets, guys. Do not begin to pretend that you think you know where the bottom is, which is why I rarely make predictions in saying, yes, this is the bottom, this is the local bottom, this is the absolute bottom, 100% we're recovering in the next week, 100% we're recovering in the next 3 months or 6 months or 1 year. You've never heard me say that on the channel in 2 years. All I go with is technical levels and fundamentals. Fundamentals for knowing if we are buying high quality long-term companies for long-term portfolios. Technical levels to understand whether or not we are taking correct swing trades with good risk to reward, or are we having FOMO or too much greed, possibly trying to buy the tops of certain trades, right? So that is the conclusion for today's introduction. Hopefully you guys enjoyed that. Now let's dive into some charts, shall we? So in terms of the SPY, of course, we're down almost 6%. Very brutal week from the start of the Wednesday session, or the top of the markets, down almost 11% overall. Now, we are, of course, hitting many oversold conditions across of many of different indicators. The first one I will present to you is the daily RSI. The daily RSI is now down to a very low level of 23.24. The best we can do is go back in history and see when has that happened, and has it translated into a bit of a bounce or somewhat of a local bottom. As you can see here, the last time that we hit those levels, as a matter of fact, was January of 2022. Thereafter, we had a significant bear market rally, but then as you can see, the markets rolled over, more bear market rallies rolled over. So of course, this one was not the absolute bottom of that market. It was just a short-term relief catalyst. If you want to go back even further, you can go back to COVID. I will remind you, why did the COVID drop stop? Because the Fed cut the rates to zero and injected trillions of dollars in money printing into the economy. That'll definitely stop a market from dropping overall. But when did it actually hit it? You can actually see that the first time that this RSI crossed this level right here, right, the 23 level, was this candle right there. And we did drop for 2 more days before a short-term relief bounce, and then the markets unraveled. So as you can see, another piece of data that shows, sure, it can be a short-term local bottom, but maybe not the absolute bottom. Taking a look at 2018, we have a few instances of that as well. As you can see, the first cross was down here, which is this candle right there. It dropped for a few more days. That's the end of the tariff situation. And then Jerome Powell categorically stopped raising interest rates. You can see now what I'm trying to say. There are large catalysts whenever it is a true bottom that have to take place. In this case as well, in 2025, that would probably be synonymous with pure dropping of all tariffs, right? Not only from the US, but also from other nations too, or maybe the Fed pivot overall. But you can see there was a few more days of drop, and then it was an absolute bottom of that correction. However, prior, we also had one too, earlier 2018 in October. That was this candle right here when the RSI cracked a similar zone. As you can see, one more day of selling, a little bit of a relief bounce, and then we headed into a bit of a very sideways and choppy market before having that other leg down. But we cannot say, well, because of the last 2 times it happened, well, we're going to have 2 legs down, sideways for a while, and then drop with Q3, Q4 data. Maybe. Nobody knows. I'm just here to show you the historical data points. And prior to that, you would have to go back all the way to August 2015, right? You can do this on your own, where we had a bit of a flash crash here. This was the candle, more downside, hovered around the lows for approximately a few months at that point, and then put in an actual bottom. And prior to that, of course, you guys, you may understand the analysis, right? We have a few other instances. Just go back in history and see what usually happens. Now, the SPY here, this was an absolute bottom. We ranged bound for a while, and then the markets found their ability to rally thereafter. And unfortunately, the last time it happened in the midst of a global financial crisis, or rather, we can go for the 2011 flash crash, but it happened a few times. A few times in 2008. If you are the opinion that we're going to go into a deep long-form recession, well, this should be the chart for you, right? If you believe it's going to be quick and fast, maybe the COVID chart suits you best. If you believe it's going to be like 2018, maybe the 2018 chart suits you best. If you are of the opinion that we're going to head into a long-form recession, then maybe the data set from 2008 will present the best likeliness for you. I'm not here to make that determination for you guys, because every single market downturn has different catalysts for the start and for the finish as well. So we cannot say that these charts are going to be a carbon copy of their prior history. That's the point I'm trying to make here. The last time that this happened in January of 08, you can see it was indeed a local bottom, sideways for a bit, and then everything unraveled a little bit more. We hit it again twice in the peak or rather the trough of this move down, but then the market's unraveled even more, right? So you can see there's a case study for making the point that sometimes it translates to an absolute bottom. Sometimes it's just a local bottom as met with more sell follow through. One thing's for sure, hard data of the past, as we've seen in the last 2 weeks, hard data of the past will not make this market hit an absolute bottom. Now, the one thing that we can know is that right now it's a product of tariffs and geopolitical relations. And until those tariffs and geopolitical relations are mended or resolved, we know that probably it's going to be very tough to ascertain whether or not we've hit a true absolute bottom. If you think so, perfect. That's your opinion. I'm not here to say the contrary. If you don't think so, that is perfect. That's also your opinion. I'm not here to say the contrary either. As I'll remind you, there's 2 portfolios here, a trading portfolio and a long-term portfolio. There's something for everyone, right? One of those portfolios, you should be very careful right now, the trading portfolio, and have a trading strategy that is in tune with bear market volatility. The other one, a long-term portfolio, you already know the statistics. We should be buying with every single paycheck, not trying to time the absolute bottom with all of our cash at one single point, thinking that we have the greatest prediction skills of all time. It's just very logical, right? So in terms of the SPY, we can move in a little bit lower here. Obviously, who's in control? The daily bears. Now, if we get a bounce from the support level, which we're in deep right now, 525 to 495, that is pretty much the lows of August, which we've cracked, and the lows of April too. Now, deep oversold, sure, but as I presented you in the previous analysis, may just be, if we do get a bounce, for a little bit of a relief rally. And then, as always, we will measure the size of the bounce. Can the bulls get a daily uptrend? And only then can we start even looking at the weekly timeframes to gauge, okay, are the bulls able to set a bit of a weekly uptrend in the context of this new bear market overall? Keep in mind, the monthly timeframes do show very severe monthly corrections right now, the MACD crossing over on the monthly timeframe, and even the quarterly charts as well, which I brought up just last Monday, also showing signs of wanting to roll over. And these are not quick fixes for the market when you lose the highest of the high time frames. Moving into the Qs right now, down 6.21% overall, right? This one as well. You can do the same analysis. This one is deep daily oversold. I'm not going to do the same thing on the Qs. We just did it on the SPY, but you'll see the events in history are largely the same in terms of when they happen, how they happen, and is it a local or absolute bottom? So that being said, daily downtrend is underway. We've now cracked the last area of support. You can argue that we have maybe a few more dollars, and I could agree. If you really want to play that type of game, right? Sure, maybe we are still in the confines of support. One thing's for sure, though, if you lose this level categorically, you're heading lower. 400 down to about 371 is the next big box, and that's a big one, guys. That is the 2021 highs and the peaks of the October 2023 sell-off. We are quickly taking a time machine right now and going back to levels that we either haven't seen in 1 year and soon even possibly 2 and maybe even 4 years worth of time. That being said, the weekly conditions on the Qs are also oversold. You can see that's happened a few times historically as well, back here in 2022 when it was some form of a local bottom, but not the true absolute bottom. And even back here in COVID, when this was the absolute bottom, because we had a bottom ending catalyst, such as the Federal Reserve, cutting rates to zero and injecting trillions of dollars of stimulus into the markets by backstopping with QE and otherwise. You can also go back in 2008 and you will see that even though the Qs hit weekly oversold conditions, that was the start of the second leg of massive selling down. So history can often rhyme, but rarely does it rather follow the exact same similar path. So keep that in mind. If we do get a relief rally, you're looking for the size of the bounce. Can we reset the daily uptrends, relieve some of this weekly pressure, or will we just head lower? We know, guys, that now every single day is going to be a challenge to, ascertain what is coming out of the White House and other foreign nations alike. None of these market conditions are going to be alleviated unless we get some more favorable statements out of the White House in terms of tariffs or from other countries as well, possibly reducing their retaliatory effects as well. So it's very tough to predict on a week-to-week basis when the data is changing so rapidly. And we know that earnings are coming up in 3 short weeks of time. The banks, big tech, everything else in between, and the guidance probably will not be so good. We know recession odds are high, and any hard data as a result of these tariffs will be coming later in Q3 and Q4 as well. So you have to keep all of that in mind, guys, right? So what it means for trading is swing trades that you're getting in longs here and possibly trying to pick a local bottom for expansion in the next 3 months. maybe a bit challenging, right? With all of that data in the way, but also shorts as well. If you're just willing to sell everything right here and go net short the market, well, what if we get some positive news in terms of the tariff announcements over the next 3 weeks? Your shorts will be underwater quite rapidly, right? And then possibly with earnings, we take the double dip, or maybe we do not. It's very tough to have longer duration swing trades than 1 or 2 weeks in this market when the data changes so rapidly every single day. Moving on to the XLF right now, down 7.32%. And this was one of the sectors, guys, where we were kind of saying, if you lose financials, which is a very large component in the S&P 500, it's not going to be very good for the markets, right? And financials now have officially been lost. They lost 2 single big levels in one day. They lost the 48 to 46 level, and now they've even lost the 46 to 45 level overall. The next line of defense is right into it right now. I'll extend this little zone, but you'll see it's a very tiny zone, right? The bigger one, arguably, is all the way back here from July of 2024. So the next level, we're into it right now. 44 down to roughly 43.50, a very tiny level. And then prior, you also come into some of the highs of this whole 2021 area, 2022, which was the peak of the market back then. Definitely a very brutal day for financials. Oversold conditions, so you could be seeing a relief rally, but who's in control right here? The daily bears. Any bounce will have to be measured, and then it's up to the bulls to prove it to us. Can we reclaim some support areas and start a weekly bounce? Yes, but any weekly bounce will just be looking as well for a lower high. Same concept. Can they reset the weekly uptrend, or do we just roll over similarly to what we did exactly back there? Monthly timeframes as well have now been lost. You have lost the monthly uptrend. The higher lows were there. You've now lost it into monthly consolidation. Monthly consolidation is not solved in one day or 1 week. It takes months and months and months to reset a monthly uptrend. So please keep that in mind when you're doing your analysis. On the 3-month time frame, we brought this up on Monday. Usually, financials tend to find somewhat of a local bottom between the 12 and 26 EMAs. You can see in COVID, it went a bit lower, and in the global financial crisis, it went a lot lower for a very long time. This is always relative analysis, so please keep that in mind as well. But financials falling off a cliff, it's very tough, guys. Very tough to say the bottoms are in for almost anything, right? Look at Bank of America. Down 7 and down 9 the day prior, or 11 rather. Bank of America flushing all its zones. Right now, the market is throwing a tantrum. It is not respecting fundamentals. It is not respecting technicals. Take a look at Visa. Visa was down 7.74, even though it was doing well, relatively well, in comparison to the rest of the markets on Thursday. Friday liquidation, it did not care. They sold down Visa 7.74%. What about Berkshire? They sold down Berkshire 7% as well into a very big correction. What about MasterCard? They sold down MasterCard 7.7%. Fundamentals do not matter. If everybody's panicking and selling everything, they'll just sell at any price, guys. The best we can do is look at very large areas of support and see, okay, where could we possibly find some buyers? And for a few of these names, we're coming into those levels soon. Same concept for JP Morgan. JP Morgan coming into a big level, 206 down to 195. Same concept as well. Will buyers step in there, or will JP Morgan have to have more of a brutal correction? You can see on the monthly, normally, the market stops it at the 26 EMA, and that could be a good catalyst to stop the drop. But 2022, the market's blasted through that as well. It went through all the EMAs, even during COVID too. So as I'm saying, guys, it's very tough to predict. Is this time going to be another event where JP Morgan gets stopped at the 26? We don't know. What we do know is that historically, it has been a good buying opportunity, but not for the absolute whole portfolio. We're just looking for levels at which the market tends to respond, and then another level below that where it could be a nice time to buy a little bit even more. So if you're looking for the most optimal levels to be buying some of your favorite names, stick to the monthly charts and go back in time through periods of correction and identify, okay, where have other people stepped in and where could I possibly step in too, rather than sitting on the hourly chart and thinking, well, should I buy here? Should I buy here? Look on a longer term time horizon. It's a bear market now. Where do the bear market buyers tend to step in when times get really, really, really dire? Moving on to healthcare right now. Healthcare also down 5.5% overall. Not the best day, but we were warning about this, right? It was a big head and shoulders pattern on the weekly. Back test of resistance. We were calling out for a bit of a short entry right here, and it played out, right? So now the daily downtrend is well underway. The daily bulls have lost it, and now the weekly bulls are in full control. We are now into monthly consolidation as well. This is a monthly downtrend on healthcare. This has not happened in a very long time. As a matter of fact, since all the way back here in or late 2022 into 2023. Now, at least we have all this zones acting as support overall. So some of your healthcare names, they could be coming into a discount, and it's up to you as well. Just, I can't go through all the tickers, guys. Just look at healthcare, the ETF overall, and look during periods of utmost corrections or recessions, where has it been a good time to start to buy healthcare? Usually it's at or below the 50 EMA, so keep that in mind when you're shopping for healthcare plays. Right now, the bears are in full control of that one too. Semiconductors down 7.5 after a day of 8.5 on the Thursday session. Top to bottom during the week on semis, guys. Semis, not the place to be right now. 17.5% in 2 trading days, guys. Obviously, we know what's at stake here. The China and US export restriction controls of high-end chips towards China. Is China going to be ever so reliant on US technology, or have they been developing their own for the past 3 years? I think you guys know the answer to that question, right? But with these export restrictions, that's what really halted the growth of semiconductors over the past 6 to 8 months. Constantly the barrage of different headlines. Export restrictions, DeepSeek now making movements as well, and also are semiconductors at the tail end of an AI infrastructure build out, right? They've not started them. Are they finishing them now? That is another question that we have to have front and center in our minds. I was saying as well that if you were to lose the $200 level, which we were talking about on the Thursday session, well, the drop might have a significant ways to go still, because the bulls never built support on the way up during that AI favorable trade. So now that we have lost those levels, we analyze, okay, big daily downtrend, deep oversold conditions, can get a bounce, of course, right? Don't know when it's coming. Maybe we drop 1-2 more days. Then the bounce comes from there. Maybe it comes on Monday. Who knows? All I'm here to say is when it does come, need to watch the size of the daily bounce. And then can they change the daily uptrend? And then only then can we say, okay, maybe we can start reversing some of this weekly downtrend as well. Very tough for me to step in here, guys, on semiconductors when I know that the biggest level of support is arguably down here, 2021 highs, 2023 fall highs as well. That is your biggest and best area of support. It is the 50 monthly EMA, which was the absolute bottom in 2022 and during COVID and during 2018. But you can quickly see if we go back here, there's a whole period in time there in the early 2000s where it did go below the 50 as well, right? It's a good place to start, but we cannot say, okay, I'm loading up absolutely the entire boat on semiconductors and crossing my fingers that all these macro events just go away and vanish. Right, moving on to the IWM Russell right now, 4.46% to the downside on growth. I was really warning people about staying in growth, especially the Russell, and now we kind of understand why, right? Daily downtrend is underway into support 180 down to about 170 is the mark. Weekly downtrend definitely in favor of the bears right now. Weekly oversold conditions too. The last time that's happened was during COVID. It went lower. The last time it happened as well was in 2018, and that somehow was the absolute bottom because Jerome Powell stopped raising interest rates. The tariffs were still kept in place. Now we have none of those two catalysts. Jerome Powell on the Friday session was very firm in saying that, no, they can wait. They don't have to drop interest rates right now because the labor market is healthy. That's what you had to read between the lines of Jerome Powell's press conference on Friday. Also, we don't have Trump stopping the tariffs. So what stopped the markets down here is not the same thing that may stop the markets at this current stage. This, however, is the lows of 2022, and that's the last line of defense, guys. You want to go lower than that, you'll have to go one step lower on the Russell, all the way down here, unfortunately, which is 160 to 150, still not an area that I would ever enter until these macro catalysts get resolved, and we have a clear path to growth ahead of us. That's the nature of growth stocks, right? They need low interest rates, and they need a clear horizon of growth ahead of them. Moving on to the Dow Jones right now, down 5.5% overall. The Dow Jones coming very hard into its level of support, 38,000 up to about 39,000. They're trying to use that area the best that they can, but even the Dow, guys, severely suffering. Who's in control? Well, of course, the daily bears are in control right now. Oversold conditions, and the same analysis on the Dow, guys. You go back in time, right? 24 on the daily RSI. The last time that happened was the depths of 2023. You can see it was a local bottom, but then it was not the absolute bottom of that correction. You can go back in 2022, and as a matter of fact, this was very close to the absolute bottom overall. That was when we hit peak inflation numbers. You'll notice that these true bottoms are always peak of something macro. Right now, we do not have the peak of something macro. We have peak fear, we have peak short-term volatility, but do we have peak catalysts right now, the European Union has not responded. We have not had any removal of tariffs so far. So we cannot say that it's peak macro overall. The company's guidance is still good. The unemployment rate is still good. The labor market is still good, right? So that's why it's very tough to just pick the RSI levels, pick technicals and say, okay, every time the Dow hits the 24 level, it's the absolute bottom, right? It does not work like that. It's just not so simple. So moving on to the weekly timeframes right now, same thing applies. Keeping that in mind, weekly downtrend, any bounce on the dailies, looking for a daily uptrend, size of the bounce will determine what's the probabilities of that happening. And then on the weekly, okay, can we recapture some of this weekly? How much? Can we then reset a weekly uptrend and put an end to this leg of monthly consolidation? But this on the Dow Jones, guys, this is a monthly downtrend. Officially a monthly downtrend. Monthly downtrends do not get solved in one day. They do not get solved in 1 week, right? It takes a long time to resolve a monthly downtrend. So the bear is in control of all time frames and pay special attention to this MACD cross after 2 years of bull market. Well, maybe we're in for monthly consolidation for a little bit while longer. I'm not saying we're going to do this, but can we just do this and hover around the same thing that we did there for a very long time until we get that momentum back? Possibly, we'll have to find out. Moving on to consumer defensives right now. So consumer defensives known to be one of the more, well, as it says in the names, defensive sector in the in times of economic uncertainty. You can quickly see that history also provides us some insight. How well do consumer durables hold up during times of market corrections? Well, 2022, they held up not too bad, but they did not go up, right? 2020, they held up not too bad, but they did not go up. 2018, when tariffs were in place, they held up decently, but did not go up. And during 2008 as well. Well, they held up better than the rest of the market, only dropping 32% versus the SPY's 50, but still, they did not go up. So you cannot say that I can just park my money in consumer defensives, cross my fingers, and my portfolio is going to be green through this entire correction. Hopefully that makes sense. That being said, the daily bears are in control of this chart right now, fully engulfing the daily leg. Support stays below 78.29 to 76. Not daily oversold just yet. And even on the weekly timeframes here, guys, setting up the weekly downtrend as well. And in that process, possibly setting up for monthly consolidation. Be very careful. If we lose the monthly higher lows, 76.16 over the next 1 to 2 weeks of trading, that will be a monthly downtrend and you'll be heading back into the deep support levels of 2022. Now, usually, the 50 EMA on the monthly is a decent time to be buying consumer defensives, that is the style of company that you want in your portfolio. It's acted as several market bottoms, even though we've traded below that. That's the key point here. We have traded below them. It's been a good opportunity to buy them, but you can see if the whole economy falls apart, we go into a recession, well, it's going to go a whole lot lower. So please keep that in mind. Utilities as well. Utilities too. Also known to be one of the more defensive sectors. What does it do when times are bad? Well, utilities, 2022 bear market, utilities went down, even though they pay a nice dividend. So I guess maybe if your equity gets eroded, at least you get to collect a dividend, right? That's fine. Nothing wrong with cash flows, but there will be some equity erosion. 2020, utilities as well went down, even though people were still paying their utilities bills. 2018 tariffs, utilities went down, and so on and so forth through different periods of correction in time. The last time we had an official recession, well, you can see, even though utilities went down less than the rest of the market, less than 50%, they still went down. That being said, we are into support right now, 77 to 72. So please keep that in mind. The bears retain short-term control of this now new daily downtrend, not quite oversold conditions. And even on the weekly timeframes, guys, now weekly downtrend, which means you are into monthly consolidation on these charts. And unfortunately now, you're really playing with fire. Loss of 74.10 would be a monthly downtrend on utilities. And the last time that's happened was early 2022. And monthly downtrends are not a very quick fix to be had. Real estate as well. Real estate too, right? Down 4.56%. Daily bears, of course, in full control of this chart. Engulfing move to the downside, flushing the closest area of support that we had, 41 down to roughly 39. Same thing for real estate, guys. When times are tough for the markets, real estate, even though it does pay a nice dividend, right? Even though it does stand the test of time, you get some nice cash flow from it, it does not survive in times of pure economic downturn. So please keep that in mind. And even energy, known as when the energy market rolls over, even though I was very bullish on this one for seasonal expansion, the tariffs have come and unwinded all of these trades. There is no safe haven. And we'll take a look at gold as well. There is no safe haven right now. So any energy trades were very quickly unwound if we were trading with a stop loss as well. Flush through a big area of support, 90 down to about 83. Now, can we blame anything right now? No, every single sector in the market is down, right? So if you had a thesis to go more defensives, all your plays are underwater just as much as those people who are in semiconductors and overall tech, right? It's just nothing is working right now, guys. So keeping that in mind, big weekly engulfing move, any bounce, just going to be looking for how high can the bounce be? Now, all of this is now resistance above us, right? A 2-year worth of higher end of support is now unfortunately resistance for the energy markets overall, as oil prices have come down, which can be symbolic of the early phases or the premise of a possible recession in the markets. Current support currently stands 80 down to about 74, and even energy names, guys. I mean, when things get bad, I mean, COVID was an outlier because the whole world came to a stop, but there's big downsides sometimes in the energy market. It's not my favorite trade. It's nice to try something thematic, but when it flushes all the stop losses, guys, we have to close those trades, lick our wounds, and just say, well, listen, we tried for the seasonal uptrend, but unfortunately a recession has just engulfed and swallowed the possibility of any equity sector being slightly favorable, at least in the short term with that sell-off. Into the VIX right now. The VIX now clipping into 50% gains, 45. Now, some of you may say, well, every time the VIX is high like this, it's always been a very decent buying opportunity for overall in the markets. And this can be true. However, you're forgetting that a lot of these catalysts were eventually solved with changes in overall policy. Not just because the VIX is high, does it mark a local bottom. You're leaving out half of the analysis. The last time it was like this was in August, right? When it resulted in the Japanese carry trade unwind, and then the markets were able to bid themselves up thereafter. We have had a large daily candle close into this level. You would have to go all the way back now at this time to the Great Recession, the Great Pandemic of 2020, where we saw, sure, it did go higher thereafter, but then it took months and months and months, guys, from literally March through May to get back to 36. And then thereafter, what happened for about a year and a half? The markets, the VIX, oscillated between 22 and 36. This entire time was a bull market recovery with 0% interest rates and free money everywhere. And still yet, the VIX remained high for almost a year and a half. So please keep that in mind. Just because the VIX is high doesn't mean it has to go down to 15. If it goes down to 15, it means the skies are blue and all these macro catalyst events have been resolved. A few other times it's peaked. They have been good buying opportunities, and similar to 2008, same concept. We got into 45, it went all the way to 80. The Fed had to do some emergency rate cuts, and that still was not the bottom of the market. It stayed elevated, and then look how long it took to actually get back into the mid-20s. It literally took a full year of time, guys, for that volatility to wane down. So if we're trying to go short the VIX from here and expecting it to go back to 15, it may not be the most logical proposition when you look at historical values, right? Although it is a short-term high on fear catalysts. Moving now into the US 10-year. So the US 10-year finally coming alive as some form of a recessionary hedge trade. Keep that in mind, right? We were looking for this breakdown on 10 and 20-year yields. Some of you may think, well, that's very logical. Trump is trying to crash the markets to bring down interest rates to help consumers out. That's very logical, guys. But if bringing down the markets triggers layoffs and this economic isolation and economic protectionism of the United States leads into some form of an economic contraction, well, even though yields will come down, it won't have the same stimulative effect as giving everybody free money, right? Even though rates can come down, it doesn't necessarily mean that people are going to be ready to buy homes, buy appliances, and buy everything else if you're going into some form of recessionary narrative. So you cannot draw these very easy conclusions and then just put everything into bonds, right? So keep that in mind because you're not buying paper here. If you're buying something like a TLT, you're buying the ETF. It's not the same thing as buying a bond. Buying a bond, you get a piece of paper that ensures you have your par value back. Invest $1,000, you'll get your $1,000 back in 5 years, and every year that bond will pay you a 5% coupon. These ETFs are not that. They are ETFs. They fluctuate with the bond prices in the open market. If you are a pure form bond holder, you don't have to worry about the price of the bond. You always get your face value or your par value back. If you're in an ETF, then you do have to worry about the price fluctuation of bonds overall. That being said, the 10 and 20-year yields are coming down, right? It's a battle between a possible economic contraction and heightened inflation. That's why there's a push and pull on the 10 and 20-year yields here. But as of right now, they are moving well, and the TLT is benefiting from a bit of an upside as the rotation into the fear trade, which is bonds, has been coming a little bit higher. So we've been able to benefit a bit on our trade in terms of bonds as I have 2027 leaps for those contracts. Moving into gold right now, I've been warning about this for a while, guys. Gold and silver are not recessionary hedges. They are inflation narrative hedges, as gold has proven to be now for the past few months, where the talk of tariffs has led into short-term expectations of inflation being higher, and gold performs very well as an inflation hedge. Does gold perform well in bear markets? Don't take it from me, guys. Just go look at history, right? What did gold do in the bear market of 2022? It went down. What did gold do back here in COVID? It went down from its peak, right? It had an initial rally and then eventually even went down. When the SPY was ripping all of 2020, 2021, gold was largely flat and or down because equities were providing a much more appetizing risk to reward profile, mainly reward, than gold. Gold is just an asset, just as everything else, guys. Just because it's gold, it doesn't mean it has to go up, right? Taking a look here, if you want to go back to the great financial crisis of 2008, yes, gold had a faster recovery from the trough to then the expansion, but you cannot say gold did not go down. It did go down. It went down a lot. From peak to trough on gold, you went down 31%. You'll say that maybe it's not as much as the equities market, but gold still did go down. What about the tech bubble? And since the Asian financial crisis? Well, gold went down in both of those cases, right? So you have to look at history and not just be seduced by gold's recent rally and think it will always last. So that being said, gold is down 2.5%. The bulls holding on to the daily uptrend right now, barely. The higher lows are at 3,000, flush 3,000. You lose that, you open the door for the daily downtrend. You open the door for much needed weekly consolidation, which is at 2836 higher lows, possibly, maybe looking for a recovery. But on days like Friday, when you're talking about an economic downturn, gold doesn't stay. Why, guys? Because when people are panicking and people want their money out of the markets, they will also sell the best performing assets and go back into cash, right? So keep that in mind. Gold can be a better hedge than most, but we cannot say objectively that gold only goes up when time gets rough. So please keep that in mind. Now, moving on to other assets such as Bitcoin. Well, Bitcoin has done a very good job. Got to admit, guys, Bitcoin has done a very good job in the last 2 days of doing absolutely nothing when stocks have been nuking. Possibly, is it because Michael Saylor is just buying up the entire supply of Bitcoin? Well, that's an exaggeration, but can we have some price support from large institutions and from Michael Saylor's MicroStrategy? Possibly. Are possibly people in the crypto space just tired of selling because all their altcoins have went to zero and they've put the remaining of their cash into Bitcoin and there's nobody left to significantly sell this asset? Maybe, but at the end of the day, you don't truly know, right? All of these are possible conclusions, but to have the actual pinpoint conclusions, very tough. Who's in control though? Well, we're under resistance. 87,000 to 92.5 is the area of resistance, and the weekly bears are still in full short-term control of this chart overall. If we do break down with the rest of the markets, 73 down to 67 is your next stop overall on Bitcoin. But I cannot possibly fathom telling you guys, because Bitcoin has held up better than the rest, it's a great opportunity to go long. You can go back in Bitcoin's history. What does Bitcoin do in overall bear markets? Well, eventually Bitcoin, the hype wears off and Bitcoin goes down as well. You can go back in any bear market, even 2018, right? That went down as well. You can use cycles, you can use other predictive analysis, but you cannot say that Bitcoin will just stand the test of time because, yes, I'm of the opinion that in years, or maybe who knows, in days, weeks, months, years, who knows, Bitcoin will probably be higher than the peak of the current cycle right now. However, can we say that this is the absolute true bottom of the short-term consolidation we've been seeing in other assets? Very tough to say. But can we also say that, well, Bitcoin is a perfect short all the way down to 20,000? Also no, right? So you have to play the charts for what they are, guys. If you are short, the stop loss should be above the most recent high and the target should be down there. Take it one trade at a time and try to avoid predicting for either extremes. Extreme rallies to extreme numbers in a short amount of time, or extreme declines to extreme numbers in a short amount of time. Take it level to level if you're swing trading. And if you're a long-term Bitcoin holder, talking the next 5-10 years because you believe in the asset, well, you should have nothing to worry about this short-term volatility, right? That goes for the rest of crypto as well. And that, I'll keep in mind, the rest of the asset market here in crypto, I've said it vocally before once, I'll say it again. None of these altcoins are going to rally until Bitcoin actually recaptures its weekly and monthly uptrends as well. Now let's get into the pain points of the market, which is big tech. So big tech will take these one by one, but nothing has changed. We've lost the trends a long time ago, guys. Well, more specifically on the Thursday video, especially for Apple here. So Apple, you got to be a little bit careful here on Apple too, right? Daily downtrend is well underway. We are almost at the verge of losing our next closest support range, which is the highs of 2024 early on in that year. So we know one thing's for sure. The daily bears are in control. Yes, Apple is oversold. You can go back historically and find if those events for these levels of oversold have resulted in short-term bottoms. The most recent one we had is just here. And here, the RSI hit a oversold level. This was the bottom, temporary relief rally, and now we got new lows. So take everything with a grain of salt, guys. The context matters a lot, yeah? Weekly downtrend is still maintained on Apple right now. Big weekly frost right now, not yet weekly oversold. The next big area of support for Apple is all the way down here, 180 to about 164. This is where you have to remember what Howard Marks was talking about. Some of you may be comfortable buying Apple here at 190. Some of you may not want to buy the asset until it hits 120. That is your determination. All I can say right now, guys, are the objective facts. Is Apple cheap right now? Versus the S&P, objectively not. 27 forward price to earnings ratio, not growing revenue that fast, and Apple does have its own host of problems, such as having a lot of its production currently tied up in China and or Taiwan and or Vietnam. We will see how those tariffs are resolved, but this one definitely getting caught up in the mix. Arguably, well, not arguably, objectively, the PEG ratio right now is very high, higher than a lot of the industry right now. So if you're of that opinion as well, maybe you don't want to buy Apple right now. If you have a long-term time horizon and you're saying, well, I think Apple is going to be worth more in the future, sure, no problem at all. But it's all about expected returns from the price that you buy an asset, right? So Apple right now, no time control for the no time frame control for the bulls right now, and even on the monthly chart, guys. I mean, this for Apple right now, unfortunately speaking, is a big loss of a monthly uptrend. And monthly uptrends, they take a long time to recapture, guys, right? When we almost lost it back here, it took a long time to eventually recover. When we lost it in 2022, right, lost the higher lows here, it did eventually recover, but it took a very long time. And right now, macro is front and center. So Apple, objectively speaking, is somewhat expensive as a company. Moving on to AMD right now. AMD also with its host of problems. It gets tied up with the semiconductor trade. And this is another example of something like BABA that I was talking about before. AMD has been very cheap since 120, but nobody cares, right? It's one thing. The markets are an equilibrium balance mechanism. It is supply and demand of shares. A company could be very cheap, but if nobody wants to buy it, it will get even cheaper, just as when it's very expensive and the valuation does not make sense, people will buy at any price. It works both ways. That being said, the revenue and EPS growth profiles are still good. Can they be revised lower with corporate guidance because of what's happening between China, the US, Taiwan, and other key markets for AMD? Yes, absolutely. But at the current stage right now, at $93, or now rather lower, 85, the price to earnings should be about 18, which on paper is objectively cheap. Can it get cheaper? Of course it can. But is it a good deal? That's up for you to determine. I think it's a good deal. Am I going to full port AMD right now? No. So there's always a balance right now. If you like AMD, it's okay to nibble a few shares, but don't ever think that it cannot get cheaper and stay cheap for a long time, as we've clearly seen over the past few months. The PEG ratio is also extremely good right now. The company has good free cash flows. They're improving margins. The revenue and EPS will be expanding with the data center trade, but apparently none of that matters for AMD right now. The daily bears are still in full short-term control, oversold conditions, any bounce looking for a lower high. Can they change the trend thereafter? We will see. Weekly, still a weekly downtrend right now. Coming into our last line of defense here. Well, last line of defense. It's a fairly wide level, yeah? I mean, I can give it all the way down to 60 if you really want me to. So right now, the last line of defense, 80 down to about $65. That's a big range, guys. It's a 20% range. It's a monthly range overall. Now, however, it'll get a lot cheaper down there. Is it good? Sure. Can we blast through the range? Possibly. AMD's done it before in the past, but any buys on AMD at this current stage, guys, have to be for a long-term thesis. Swing trades long, if you want to go for oversold swing trades long, you can. It's completely up to you, yeah? But if you're buying AMD shares for the future, you have to agree with the fundamental thesis that the company will be able to expand gross margins, net margins, and scale EPS and scale revenue. I think they can do it. I think they have a good risk to reward profile right now, but it may take months or years for you to actually see the true gains that we're looking for here on this AMD thesis. Moving on to Amazon, one of the best companies in the world, not getting spared from the sell-offs in the most recent few days. Down 4.15% at one point early on in the day. Amazon would open the morning, right? Pre-market was down like 7-8% with the rest of the market. Held up well, but then faded into the close. That being said, who's in control right now? Well, the Amazon bears definitely are in control. We're into support. Of course, we're into support. The 173 down to 150 level is a very attractive level. It is the highs from 2021 overall. Not that bad. If you were to go back in time, is it a good idea to buy Amazon, both for a swing trade possibly or a long-term investment when it gets weekly oversold? Yes, the last time it happened was here on this candle right there. Did it go lower? Yes, indeed it did. Short term, but also thereafter you had another leg down. So the question is to you, do you want to play this for a swing trade at which it could be a good candidate for a oversold bounce relief rally with the rest of the SPY and the QQQs, but have defined levels of take profits and stop losses? If it's for a long-term investment, well, the thesis is quite simple. Amazon, objectively speaking, is somewhat cheaper than it's ever been. At a forward price to earnings of 28 and a forward PEG ratio of 1.4, the company objectively is cheap, especially when you look at its growth prospects. However, this is part of the big tech trade, one of the trades that Europe may crack down on with a number and host of either regional bans, regional regulations, fines. We know Europe has been very keen on levying fines and payments on big tech over the past 3, 4, 5, 6 years. Accusations of monopolies. Are they going to stop if the Trump administration keeps their pressure on with the tariffs? Probably not. The biggest pain point you can target for the US right now is their services, and big tech remains a large service provider, well, both for goods for their e-commerce, but services as well. Amazon provides a lot of services. Their growth profile for EPS and revenues look attractive right now, but does maybe none of this, can it go down to a 20 price to earnings? Yeah. Can it go down to a 15? Yeah. Do we know? No. So it's up to you to make the determination. I'm fine with buying some Amazon here for my long-term portfolio, and I will buy it as it keeps dropping as well, but we cannot say it's a bottom. It looks good for a support range trade, for a short-term swing trade, but for a long-term portfolio, if you agree with the company and you want to hold it for the next 5, 10 years, also a very decent buying proposition for Amazon. As I've been saying though, for the last few weeks, guys, we need to be nibbling here. We need to really be nibbling here and make sure not to blow all our cash before we have more macro clarity. Moving on to Google. Google was in the example in the introduction as well. Google has been objectively cheap now for a while. Technicals first, then fundamentals, daily, downtrend, oversold conditions on the daily as well, entering nice weekly support on a weekly downtrend with a lot of momentum. Google is now down 28% from the all-time highs. Google in 2022 went down 43% from the all-time highs, and that was just due to inflation concerns overall, right? So Google right now, objectively speaking, at the low 150s is trading at a 17-16 forward price to earnings. Objectively speaking, that's cheap, but if nobody wants to buy it, then nobody cares how cheap it's going to become. I gave you the example of BABA. Can this go down to a 12, 13, 10 if the SPY and the QQQs get worse? And if we go into a recession, possibly, if they reduce their EPS guidance as well, that's not going to help too, right? Forward PEG is 1.16. So on paper, objectively speaking, is it a good opportunity to be buying Google for the long-term future? Absolutely. It's been that way since the 170s and 160s, and now it's gotten even more attractive. But can we full port Google right now and expect this to be the absolute bottom and go to the absolute moon thereafter when the SPY, the QQQ, there's economic recession probabilities? Probably not. But will most buys made here be rewarded with a long enough term time horizon? Yes, absolutely. So you should be looking at these things with not a 1 week time horizon, not a 1 month, not a 6 month. Whenever I buy something in my long-term portfolio, my time horizon is 5 to 10 years, guys. Not shorter than that, because it's impossible to predict the short-term market swings. We'll do more technicals on this, but you'll see that Google, last time it did stop, was all the way down there in 2022 around the 50 EMA overall, and the Class A shares have a bit more data. You can see when times are rough, between the 26 and the 50 EMA, excuse me, is a very good buying proposition. I did it again, guys. My chair came out. I leaned back too much on it, and then the thing that holds it in place kind of lines to lock it back. But you can see back here, guys, if you go to 2008, the 26 and the 50, well, the 50 wasn't even there yet, but it didn't even matter. It did go below, right? So can Google get cheaper? It can, but we should be buying this one with a long-term time horizon. Short-term swing trades are always the same. We wait for the daily uptrend, crack of the daily uptrend, stop goes below the lows, and then you target the region of most recent highs. That's how we should be swing trading, not saying, okay, this is the bottom, and trying to build swing trades from there, right? It's okay if you have a long-term portfolio, but swing trading, you got to be a little bit more careful, okay? Now, moving on to Meta, good old Meta, down about 5.06% overall. And Meta, even though Meta has dropped, from the highs, 32, 33%, sure, it's at a better deal than it was roughly a month and a half ago, but is it objectively speaking a good deal? We'll find out. Daily downtrend right now is well underway. Oversold conditions could be due for a short-term relief bounce. anywhere in the support range, 531 to 453, which are objectively the next big areas of support for this current stock right now. Now we take a look at the monthly. Those are also the monthly lows, still in a monthly uptrend right now. But as we know, right, Meta is the poster child for when something gets cheap, it can get a lot cheaper. Meta, objectively speaking, was cheap in March of 2022. Didn't prevent it from losing another 50% thereafter and drawing down an incredible amount. It was cheap from here. It just got cheaper and cheaper and cheaper and cheaper. So for buying Meta today, we agree that even though the stock is cheaper than it once has been, it's not objectively the cheapest point that it can possibly become. Right? That being said, forward price to earnings, 21. Forward PEG ratio, 1.62, and the free cash flow yield is good. Now, the forward prospects for Meta do look good. Be wary of the monthly MACD cross. This is a 2-year bull rally with the first monthly MACD cross like we saw on the SPY and the QQQs. Tremendously profitable company, very bright future for the next 3, 4, 5 years, but tough to predict if this is the absolute bottom. Nice EPS projections, nice revenue projections as well. But can it get caught up in the headlines and go low as it did back here? Absolutely, it can, guys. And Meta's fundamentals did not fall off a cliff in 2022. Sure, EPS went down. Meta was bumpy for a while there. Revenue as well. Revenue didn't even drop by that much. It was flat. And still, the stock sold off over 70, almost 80% from the highs. So keep that in mind. Will buys here on Meta eventually be rewarded? Probably. Will buys, if you wait down here, be rewarded eventually? Probably as well. But we cannot pick the absolute bottom and say, okay, now's the time. All the money I'm willing to allocate ever to Meta should be put right here. So keep that in mind. Microsoft is also the same concept. A tremendously strong company is Microsoft right now. Now, that being said, who's in control? The daily bears are in control right now. Further daily downtrend and loss of support, 380 down to 365. Microsoft approaching daily oversold conditions. Any bounce, need to find the new daily uptrend to be sure that the weekly bottoms are locally found. And then same thing, right? Are we just looking for a lower high? We have to measure the size of the bounce too, right? And then can we get a lower low? Well, we'll see. But the next area of support is down here, 346 down to 320. So was this a good buying opportunity for Microsoft? Yes. Is down here a good buying opportunity for Microsoft? Also, yes. But keep in mind the markets now are in monthly downtrends and Microsoft is largely the same. Those are the 2021 highs. Now, it's always a good idea to buy company at previous highs. We can go back and measure. You can do this with all the stocks I'm covering right now. You can go back and see, well, okay, what was their EPS back in 2021? A lot lower than it is right now, by about 50% lower. What was their revenue? 168 billion this year, 276. So that is a net jump as well. So are we getting a better deal for the same share price today than we were back then? Yes, Microsoft can fall to the 50 EMA. It has done it many times in the past, but it can also go lower if we're talking about a possible economic recession. So please keep that in mind. Essentially what I'm saying is nibble on all these stocks if you're a long-term portfolio holder, but in terms of short-term swing trades to the upside, can't really be possible. We're downtrending everywhere, monthly, weekly, and daily. So if you're trying to pick the bottoms for some swing trade longs here and go for the absolute recovery, you know, it's going to be a very rough time, possibly. Moving on to Netflix right now. Netflix was one of the ones that had the highest valuation, objectively speaking, yeah? Now it's down to about 850. So I will redo this valuation because now it's a bit far away, right? 855. We can redo the math together here. Let me just redo it very, very, very quickly with the same EPS. So 855 divided by 2481 forward EPS, that's a 34.46. You can see Netflix is objectively expensive right now on a PE basis. You divide that by their EPS growth, and sure, a 1.5 peg is decent, but is it very, very, very cheap? No. Google is trading at like half the valuation right now in terms of a forward price to earnings ratio. Netflix right now got to be a bit careful. Flush the lows on the weekly. The weekly is the best time frame right here because yes, it is a daily downtrend coming into the last line of defense and the 200-day EMA, which all the other companies have lost, but not Netflix so far. Now, keeping in mind also the head and shoulders pattern. So if you're of the opinion that the markets drop further, maybe you want to enter a short based on this pattern alone, right? That being said, on the monthly, be wary, guys. Netflix has run a lot, similar to Meta. The MACD is not looking so hot right now either, starting to curl over. The 3-month time frame should tell you everything you need to know about this company. It can pull back into its quarterly EMAs, and when times get brutal, can also go lower than that. I've always been saying on the channel in the last few weeks, my absolute best entry for Netflix is down there. Is buying Netflix here a bad proposition? No, the company is very solid. Can we get better deals? Maybe. So if I had to build a position on Netflix, I would do so slowly, because we don't know what triggered the drop here on Netflix. Netflix objectively was cheap after the first drop, but it still dropped more, right? And the proof of that, I mean, Netflix didn't really lose that much in 2022, objectively speaking, yeah? 2022, it didn't lose that much EPS. 2022, it didn't lose any revenue, but still, the market sent it reeling to the downside, disregarded all fundamentals, and the company was a lot cheaper than it was today, even on a price to earnings basis and even on a PEG ratio basis as well. So please keep that in mind. Moving on to NVIDIA right now. NVIDIA, same concept. We know NVIDIA, the problem is not with the company, guys. A stock is not the company. A stock price is not the company. NVIDIA is a fantastic company with fantastic competitive advantages, fantastic products, and fantastic services. What's NVIDIA's problem? The problem is that the revenue growth is declining. I'm not saying the revenue is declining. The growth rate of that revenue is declining. If you don't believe me, here is their own forecast. Their own forecast stipulate here for tapering off of the EPS growth rate, tapering off of the revenue run rate as well. What will be the refresh cycle for NVIDIA products? Everybody bought Hopper products. Fewer people will be buying Blackwell products. What about the further generations? Are big tech companies just going to refresh hundreds of billions of dollars of GPUs every single year, like the consumer GPU market is going? Arguably not. Will they refresh a fraction of them every single year? Yeah, but what does that translate into? A terminal growth rate for revenue for EPS and revenue for EPS growth for NVIDIA. Those are the things plaguing NVIDIA right now. Not just that the stock, the market doesn't like the stock, right? Daily downturn is underway. Next area of support is here, 96 down to 77 overall. Weekly remains in a poised weekly downtrend too. We are now not yet weekly oversold and have a wide range of support to be basing our trades off of right now. At $100, the stock is objectively cheap. 22 forward price to earnings and a PEG ratio of 0.96. Free cash flow yield is also quite decent. Can it drop lower? Of course it can drop lower, guys, right? I'm not saying we have to pick the absolute bottoms of NVIDIA here, but if you like this stock, if you like the growth prospects of the stock, if you want to stay in the stock for the next 5 years because you want to see what they can do and you believe in them, then sure, now is definitely a decent buying opportunity. But if I have $1,000 to allocate to NVIDIA, am I buying $1,000 here? No. I'm nibbling. I would rather nibble here, and then eventually even on the upside, here, and build a position within the next few months and then carry that position in the next 5 years, not just YOLO it at this one price and say, this has to be the bottom, 100%. The VIX is high, the fear is high, everything's high. This is the absolute bottom on NVIDIA, right? It's not how it works if you have a long-term time horizon. And for any swing trades, I'll remind you who is in control here, not the bulls. The bears control every single one of these time frames. And even the monthly right now is being challenged. Monthly MACD cross after 2 years of nice expansion. The monthly MACD is now crossing, so keep all of that in mind for NVIDIA. On to Tesla right now. Tesla down 10.42% overall. Not the best day for Tesla. Unwinding here, daily downtrend out of rejection of resistance 300 down to 260. We know that Tesla has its host of problems. Deliveries came in an underwhelming fashion, down 13% year over year. You can argue that some of it is for the Model Y refresh. You can argue that some of it is because of brand perception. You can argue that some of it is because of what Elon Musk is doing with Doge and not being at the helm of Tesla. I think it's a combination of all factors right now. One thing's for sure, though, the weekly bears are in full control of this chart. And if we come any lower and have another weekly leg of selling, Tesla's going down to 220 all the way down to $190, which is also why it's very tough to say this is the bottom. This is the bottom, right? If you're a long-term Tesla shareholder, you guys know the long-term vision. These are the long-term catalysts. We talk about them many times on the channel. It's a 5 to 10 year plan. So any short-term trades as well should be done with stop losses at recent levels. Any long-term investments should have the long-term thesis of the next 5 to 10 years in mind and disregard short-term price action and should be willing to buy whether Tesla goes down into the 150s, 100s, who knows? That would be a more ideal location to start those positions. However, moving on to Palantir right now, down 11.47% overall. Palantir losing the daily uptrend, daily downtrend right now into support 72 down to $64 on the weekly timeframes as well. The weekly bears have now officially taken control of this chart. This is the first weekly downtrend on Palantir since all the way back here, guys, all the way back in March of 2024 when they actually set the weekly downtrends overall. Yeah, it didn't happen that often on Palantir. Now it's happened again. I was warning about this, guys. After such a big retracement, you got to be careful. The likely move is either a tightening range, but not a V shape, not when SPY and QQQ were in weekly consolidation and weekly downtrends. It will not happen. Right now, you have to be wary. Weekly downtrends mean monthly consolidation. And when you look at this monthly chart, Palantir can come down and tag the 12. Where's the 12? Glad you guys asked. At $60. Is that the absolute bottom of Palantir? Well, you guys know, and you guys should have been saying no right before me, right? Palantir right now, objectively speaking, is quite an expensive proposition. I'm not here to tell you whether or not it's a good buying opportunity at such an expensive valuation, right? Objectively speaking, the categorical answer would be no. Will you be rewarded from these share prices in the next 2, 3, 4, 5 years? Maybe, right? What's going to be the ROI? Are you going to have better ROI than someone who buys down here? Probably not, right? So that's the question you have to ask yourself, like Howard Marks was saying, right? You have to make a determination whether the current stock price reflects all the current macro conditions right now and whether you want to buy it at that price and think that everything is priced in. Keep that in mind for Palantir. Monthly consolidation could continue. The bottom end of this support is 65 and the 12 EMA on the monthly is $60. If you ask me my opinion, I would love to buy Palantir, guys. Don't take it the wrong way. I'm a Palantir shareholder as well. I would like to buy Palantir truly around the $40 mark. Take that for what you will. I'm not saying it's going down there. I'm just telling you where would I like to buy it? I would like to buy it at 40 bucks. Moving on to SOFI. SOFI also getting killed, 10% to the downside, daily downtrend underway, deep into support right now at the bottom end of support, $9. That is a large weekly support level, the top end of the resistance range from earlier 2023, the IPO price, and a bit of challenge right here as well. That being said, SOFI is still in the context of a weekly downtrend. The valuation for SOFI is quite attractive right now at $9. Forward price earnings is a bit high, but they do have tremendous amounts of growth in the future as well. They are a bank, though. They have credit and default risk. That is what's being priced into the stock right now. Price to sales is very good. If you have a long-term time horizon on SOFI, you think the secular trend is a move more towards digital banking than legacy banking, then this one might be a good play for you if your time horizon is measured not in weeks, not in months, but possibly in years to get the full value out of that thesis. For swing trades, I still enjoy playing short puts under the market, but will be very, very, very conservative. I have a few swing trades ongoing on SOFI right now. I'll show you those at the end of the video too. Now that's going to be it for our stock recap. I'll do Uber and TSM. I really want to get into the portfolio right now. We've got a lot of things to cover on the portfolios, and I want to keep this video under an hour and a half because it's been long, but we had a lot to talk about, guys, on this recap and the thoughts and the sentiments as well. Yeah, so let's dive into the portfolio right away, shall we? And you guys know I'm always very transparent with the wins and very transparent on the losses. You guys have seen me run these portfolios for the past 2 years. 2023, we had a couple times where we were underperforming the market and ended off the year green 75% as we were navigating throughout the different times of 2023. 2024, same concept. You guys saw me lose a ton of money on some earnings plays, underperform the market, round trip a bunch of gains, ended that year, last year, with a 55% positive return. This, again, is one of those times where I tried to play the market, and as it is a trading account, guys, of course, you want to have certain benchmarks, but certain benchmarks apply in different scenarios. And I'll explain to you exactly what happened, very transparent. Here is the trading portfolio. We started the year with about $45,500, $46,000. You might remember the last 2 years, I was running about 100K. I took my gains, reduced it to about 46,000, which is a more manageable portfolio size in terms of just displaying YouTube trading strategies for various account levels. It's a bit more relatable, right? But when you have a small account, you have to put on a bit more risk if you want to go for those outsized gains and grow it quickly. You also have to make directional bets in the market sometimes as well. And that is exactly what happened here. So here it is, guys. The portfolio right now is down 33.5% year to date. You will see that before the tariff date, we were only down a cool 13% year to date, which was arguably underperforming some of the indexes, not all, but now this is the result. We have now lost, we've round tripped a lot of gains. You might remember portfolio was sometimes sitting about $55,000. Overall, this is the nature of a trading account. And keep in mind as well, in terms of the Discord members as well, they do not have the same portfolio allocations as me. I have higher risk tolerance than a lot of people. I take plays that I do not advise other people to take as well. And running such a small portfolio, you guys now saw the impacts of margin, where I was levered up on a factor 2-to-1 on margin here. Then when Trump hit us with all of this, we went underwater. I chose to deploy a bit more margin leading into the tariff announcement. My thesis as to that announcement was that we were, at that point in time, into short-term maximum fear catalysts, and that tariffs, if they were to come in line with people's expectations, Goldman Sachs, JP Morgan, other people's expectations as well, those are the prediction, 10%. And in the after hours, when they did release 10% tariffs, I'll remind you how that day went, right? That day, it went up in the after hours when Trump said 10% baseline for everyone. It only dropped off a cliff when we saw 35% plus. That is when I started de-risking a little bit. And then on the Friday session, midway through the morning, I decided to sell absolutely everything. Not because I'm panic selling the bottom, just because those swing trades were indeed long swing trades. I was expecting a weekly bounce out of the tariff announcement, wind down some positions, and reset. Now that we've broken into the bear market territory, and now that we know that the premise of the Trump tariffs are not going to be quick resolution, not a negotiation tactic for the most part. He really wants to bring back manufacturing jobs, with which he has vocalized himself and his members of his cabinet have said, yes, there will be a detox period. There will be short-term pain. Now we know what that means. China retaliated with 34% tariffs, and the Trump administration has not budged just yet. As a matter of fact, he said on Truth Social that they made a big mistake. And when you read between the lines, that's saying that it could escalate a bit further, and we're impending further news from Europe as well. Notice I showed you earlier on in the video the long-term portfolio and saying that I'm not selling, guys. This is a long-term portfolio. This is a trading portfolio. You can argue here that I made a mistake by going on margin. You can also argue that I was wrong on my thesis by putting on the leverage back, going for the upswing trade. That was the trade thesis. It did not work out, and now we have to suffer the consequences of those losses, which is why I cut most of those upside swing trades into the Friday session when we broke those lows. Can we possibly say that I sold the absolute short-term bottom? Maybe, but even if we would have had a bounce on Monday or Tuesday, I'm not here to predict if we're going to have a bounce. I'm here to reposition the portfolio when the data changes and pivot the strategy. You know that I've been running the wheel strategy and several directional bets, small directional bets, call debit spreads when the time is right, leap call contracts when the time is right. Unfortunately, now that the data has changed and now we know the implications of the tariffs overall, we know the retaliations are going to be set forth. We know that on Friday, Jerome Powell was very vocal as well on saying they're in no rush to cut interest rates. Well, we have to adopt more of a bear market strategy, and my positions were not in line with that strategy. So yes, we are down 33.5%. Do I have a plan for the future, which does not imply shorting the market for all it's worth? Sure. And if you've made a lot of money going on long puts and taking the other side of that trade, going for a directional short bet, congratulations, guys. But to each their own, you have to have your thesis, right? A lot of the Discord members, if you're wondering about the Discord members, is everybody safe? Yes, a lot of people's drawdowns right now are sitting anywhere between 10 to 15%. A lot of them are sitting less worse than the drawdowns of the market, right? Even if you're sitting in the SPY, you're down 17%. You saw my long-term portfolio, it's down 20% in line with the Qs. If you're just sitting in ETFs, you're down as well. So my rate of return year to date, 33.5. Sure, I'm underperforming the markets right now, but keep in mind, this is somewhat of a leveraged account where I take concentrated bets for directional trades, right? Now, of course, even if I would have had some hedging, guys, would the return have been less negative? Yes, but it wouldn't have meant that the return would have been overall positive, right? So let's discuss exactly what happened and what the portfolio positions are going to be in the future. Here is the sell notifications for everything. Here are all the sales. This is everything, guys. All the little swing trade positions that I built over the past few weeks, trying to go for the upside in ownership trades, like share trades. We had some leverage bets on AMZN. We had a Google assignment. We had a Google call debit spread, leap call contract. We even had a few leap call contracts that I did not want to close just yet because I was waiting for that exit capacity for a bullish rally out of oversold fear sentiment trades. Going back in time, would I have made the same decision? Yes, because you guys know me, right? It's not as if I'm taking crazy trades to the upside. I'm not buying Palantir at the all-time highs. I'm not buying HIMS at the all-time highs. I'm buying high-quality things at lows in the markets and trying to play it from there. I was positioned into the tariff date at an extreme fear read of 8 bullish. I wanted the weekly upswings, understanding that we are in the context of weekly consolidation. I was looking for this. Exit there, repositioning. I didn't get it, had to bite the bullet overall, guys. But please keep in mind, yeah, it's a short-term swing trading account. And I'm telling you that the account value, well, I can't guarantee it, but I'll do my best. You guys have seen in 2023, 2024, right? We took many drawdowns, switch up the strategy, adjust to the data, and then we start readjusting the strategy and playing a new strategy according to the type of market that you're in. If this is going to be a market where volatility is extremely high all the time and where drops or rallies are somewhat unpredictable and that you cannot really hold swing trades into multiple week sessions or multiple month sessions with confidence, well, then we're just going to play the volatility. And I got a deep tool bag for that as well. But I'm never going to hide losses, never going to hide the portfolio values from you guys, because there's something to learn from all of this. If you want to know, I mean, Discord members know as well. I have another large trading portfolio in which I also employ the wheel strategy. That was 40% cash leading into this. Now that one is down roughly 9% year to date. I also closed all the swing trades in terms of the wheel trades that I was managing. You might remember I was in Google. We were managing the loss with covered calls all the way down. You know, I was showing you guys the assignment trackers for these. We're trying to lower the cost basis with covered calls. But unfortunately now some of the assignment prices are getting a little bit too high and the market conditions a little bit too uncertain to say, yeah, I can probably sit in this one into earnings, into tech earnings in the month of April. I can probably sit through reciprocal tariff implications from other countries and crackdowns on big tech and probably ensure myself that I get out at the covered call location. I'm not going to take that risk in these current markets, guys. So that is why I closed all the positions and we reposition and go to the upside now. So what does that mean? I kept a few portfolio positions open, but for the most part, they were all closed. So net down approximately just around $15,000 right now, which is manageable. I mean, on the 100K last year, guys, I made like over like 50 grand, right? So sure, I'm giving back some profits and sure it sucks for, you know, the show me points for the YouTube, right? I can't say, well, look, like my account's up 2x while everybody else is negative, of course, right? But that's not the point, right? The point is I'm trying to show you guys the different strategies to employ in different markets when I feel a determination needs to be made to close certain positions, wind down an entire strategy, and shift to somewhat of a different strategy. That does not imply that I'm going net short on the entire market, long puts on everything, short NASDAQ futures at the bottom. No, right? We're going to do this in a very calculated manner. And even the options video tomorrow, the top 5 options video, that will also display the new bear market strategy. If we're expecting high volatility, high uncertainty, and a rough year overall, we need to pivot the strategy overall. Don't worry about me. If the market just pivots long and this trading account is left behind and I once again have to pivot in the future, don't worry about me, guys. I have the long portfolio for that as a hedge to the upside, right? I don't mind about that, right? But right now I'm playing what the market is giving me. I'm looking at the cards on the table and saying, okay, what strategy should I be using right now that the bear market is confirmed and now that we know that tariffs may not just be the negotiation tactic that people are saying them to be, right? What's going to happen, right? Is Trump just going to suddenly, he has to break one of two promises. The first promise is we're going to bring back manufacturing jobs to the United States, right? Well, you can't do and bring revenue. The tariffs are going to provide an incredible amount of revenue to pay down government debt. Well, what's he going to do? Cancel all the tariffs next week and just go back on those two promises? Or he's going to leave the tariffs in place. If he leaves the tariffs in place, it's going to cause a lot of more pain and volatility in the short term, right? So you have to go with one of the two theses. Right now, I'm going on the premise that he will leave the tariffs possibly on most countries to generate that revenue and possibly bring back jobs to the American market, which should cause more pain in the short term than it causes long-term gain, possibly in the long term. So being that as it will, with the VIX high and volatility at the highs, pivot of the strategy. So that's a very long-winded introduction, but I got to give you guys the premise and just not say, well, I sold everything at the bottom, guys, good luck, right? I'm still trading, and a lot of these trades, most of these trades are going to be long, but I'll show you what I'm doing here now, okay? So for the portfolio, all the cash will now be put in something like an SGov. The cash needs to generate some capital, and we're not going to be looking to get assigned anymore. These SGovs are money market funds. They pay, well, this one, it's not listed properly. It pays about 4.8%. You can go with BIL as well. It's 1 to 3 month treasury bill ETFs. It pays you the current Federal Reserve rate on bonds, right? It's the same as a short-term savings account. So that's our baseline. All the cash, or most of it, will be in short-term treasuries, but I can still sell these ETFs at any point if ever I get assigned. Here are the style of positions. You can see I did not sell everything. I did not sell the Elf Beauty. I did not sell the Grab. I did not also sell the Restoration Hardware meme trade for 4 shares that I have going. And I did not sell the position on SOFI nor the TLTs. But what I did do is take several trades that are well well below the expected moves, and I'm cutting my ROI expectations in half. You may remember the wheel strategy that I like to run on the channel for the most part. The wheel strategy in a normal bull or sideways market stipulates the following. We are going for 0.5% per week. Now I'm cutting that in half. With the heightened volatility, you guys know as option sellers, we can make more premium if we keep the same strikes, but if you go well below the market, you can get decent premium for arguably the same. Look at these QQQs, for example. These QQQ 360 puts for next Friday. My strategy going forward, guys, is I'm in cash on Monday for the most part. Well, now I took on Friday because Friday was a good opportunity with the high VIX, yeah? Now, the goal moving forward is no more swing trades, holding swing trades from week to week to week to week, going for trend continuations or whatnot, not doing it. Now, cash on Monday, cash on Friday. True trading, right? You guys have seen me hold the positions over the past 2 years because the overall markets were okay. I'm not calling the bluff anymore. Cash on Monday, cash on Friday. So that being said, these are all weekly options. Look at these options. The ELFs I took Thursday overall. So those are still chilling right now. 44.5 strikes. It's well away from that 55. We'll see what happens though. It's a DCA attempt. Anyways, I digress. QQQs, 80 cents I got on Friday, about 30 minutes before the close. They ran deeper, they sold off an extra 1.5% into the close. Even if I took these at 330, it was not the bottom. But you can see here, 360 short puts for 80 cents. The 0.5% rule would stipulate half of 360, you need to find 180. I'm going for the 0.5% rule. It's about 10 to 15% annualized ROI. So keep in mind, on BIL, I'm already getting on my cash roughly 4.7% on all the trades that I'm employing with that cash that's preserved, because that's the good thing, right? I don't have to use the cash until I'm assigned. So if I can collect 10 to 15% ROI per year annualized, no compounding, right? Because we'll be doing these trades week to week to week and building the account back over time. I'll be getting both of those, the interest on the cash, and also I'll be collecting 0.5%, right, per week, which is roughly 10 to 15% annualized, depending how much over of that you are or slightly under. The Qs, I'll just use this as an example, and you can see the rest of the positions. These are all the same trades. The Qs, 360 by Friday. Can the Qs drop 360 by Friday? Maybe, but that will be an additional, look how much of a drop that is, guys. That's an additional 15% drop on the Qs by Friday. I'll take my chances with that type of trade. You can find many of these different styles of trades. If you want to know what the delta is, these are all 96, 97 delta trades, meaning that if I take these trades 100 times, 96, 97% of the times, I will win. I'm going well below the expected moves, guys, like 2-3 standard deviations away. Can it happen? Sure. What's the expected move for the Qs by Friday this week? I'm glad you asked. It is to the low end, 399. I'm going 2-3 standard deviations away from the expected move, benefiting from the high VIX, and that is how we're going to trade moving forward in the bear market, going for these, I call them lowball, cutthroat prices on everything. The same thing I did on KWeb, 25 by next Friday. How much of a drop is that on the China trade overall? On KWeb, still, again, guys, it's very, very low, right? KWeb 25, that's literally an additional 20% by Friday. Can it happen? Sure. Is it likely to happen? Probably not. Same thing on the rest of things, right? SOFI is different. Uber, $50 puts. Same concept on Uber, yeah? Uber, $50 puts. Can Uber drop all the way to 50 by Friday? Maybe, but that's an extra 22% in one single week. So you guys can see what I'm doing right here. I'm going for things in daily oversold conditions below. They have to crack, not only do they have to crack all the supports, but they have to go 3 standard deviations, guys. I'm putting all the odds in my favor of not being assigned and collecting roughly 0.25% per week, which on an annualized basis is 10 to 15%. If the SPY and QQQs stay red the entire year, well then possibly this is the best strategy that I can do to farm premium. And if we get signs of a bull market, tariff goes away, we can pivot the strategy again. But this will be my strategy moving forward, a lot simpler of a portfolio. No swing trades, no leap call options just yet. I'll let you guys know when the market is going to be there for leap call options. Trust me, I'll take them too. It's not the current time, in my humble opinion. It's also not the time for some swing trades with some shares, trying to pick the bottoms, holding them for weeks and months on end. Not the time. I've pivoted the strategy now. Cash on Monday, cash on Friday. Hopefully all of that makes sense for the strategy. So these are the positions. Look at this Palantir position, 45 short put for Friday. These are the types of contracts that I'm looking for, guys. Palantir, 45 short put for Friday, 39%. Can it happen? Sure, anything can happen. Is it likely to happen though? Probably not after these 2 massive drop days on the SPY and the QQQs. These are the styles of trades I'll be looking for, and there will always be every week certain companies that respect these lowball cutthroat offers when the VIX is relatively high. If I'm expecting an environment where the VIX can, maybe this is the peak, maybe it can go higher, I don't know. But if I'm expecting a market in which the VIX stays high, we're going to be able to find these styles of trades every single week over time. And that is the style of position, style of trading strategy that I'm going over. 5% or 4.5% from the yields, just from interest on the cash, and then going for 10, 15% annualized ROI on the trades itself. Those should be benchmark beating returns. Now my benchmark is no longer the S&P 500. If I am expecting the S&P to be negative this year, possibly, or very low returns, my benchmark should not be the S&P. My benchmark should be the risk-free rate of return. If I were to pull everything out of the market, put it only into money market funds, only into a collateralized deposit, or only into a long-term bond, I would be making 4 to 5%. I want to beat that benchmark with the trading account without taking on too much risk and without playing directionally too much. You know, I can do day trading all day as well, guys, but I'm trying to give you guys a strategy if you still want to be passive and still want to make some money in these markets while being extra conservative on a weekly basis. This is maybe something that you can apply, or maybe an idea moving forward for your own trades. The other ones I'll manage. ELF, I'll keep it all managed. Grab, I'll keep it all managed. A Restoration Hardware, that's just a meme. I'll keep those shares all managed. Don't worry about 4 shares for me, guys. And SOFI, I will keep it all managed. I have one contract coming through this week for 11. Maybe I get assigned, maybe not. It'll lower my cost basis, and I am keeping the TLT swing trades too. The rest of the ones, Uber, QQQ, Palantir, KWeb, and that's pretty much it. The Elf Beauty 44.5s, which is a DCA attempt, which I did on Thursday, those are all going to stay for Friday. I'll update you all throughout the week, and I will be swapping these positions up quickly. What the good thing about this strategy is you're riding so far away that any green day or small red day will collapse the premium out of these contracts very, very, very fast. And then we can close them, find new, very low ball offer trades when premiums are high, the VIX is high, and we're going to be able to rotate these trades somewhat often rather than trying to day trade. I don't want to make this a day trading channel, even though I'm pretty good at day trading, you know, futures or gold or, you know, daily SPY or QQQ contracts or stuff like that. I'm not going to be trying to do that, guys, nor taking heavily sized swing trades like being on the 15-minute charts. Like, yeah, I can show you guys day trading strategies. I'm not going to be trying to do like, okay, pre-market highs and lows are this. We're going to go for upside longs. I'm taking it from here to here, $2. No. This trading channel has always been about how can I get premium from the markets in different trading environments. So I always have something deep in my bag. And you might ask me, but what if the market rallies? That's fine, guys. When the market rallies, you'll see what I'll be doing. I'll be doing a combination of call credit spreads, a massive rally into resistance, call credit spreads with a high VIX as well, well above the market, especially if the macro data hasn't changed, and SQQQ short puts as a hedge, guys. Any bear market rallies will mean the SQQQs pull back very, very hard into big levels, right? Pull back hard off of any rallies. Perfect. I'll do short puts all the way down there. Deep on a weekly basis as well, and still get to collect the premium in either way. Market flushes, I'll collect premium way below. Market has a huge rally, hourly overbought, 4-hour overbought. Perfect. Call credit spreads above the market and deep short puts below the SQQQs. This ETF provides a tremendous amount of premium, all things considered. That is how the short-term trading account will look like for the foreseeable future, as long as the macro catalysts are not lifted in the markets right now, which, you know, we'll see, but we have all the earnings to get through as well. That's why I can't fathomably, guys, hold the bag through the rest of retaliations. You know, the long-term swing trades is just right covered calls above the strike, right covered calls. No. I need all my cash back. I need to be nimble. Cash Monday, cash Friday, and we incrementally make the losses back over the course of this year. That's the best thing that I can possibly do for myself and the best possible strategy that I can show you guys. Because I'd be lying if I told you guys just use the same rules in a bear market, right? It does not work like that. Everybody knows the wheel strategy overall, it's a great strategy. Up market, sideways market, slightly down market, we were doing fine. But a pure form bear market, high volatility market, you have to adapt. The trading strategy has to adapt, right? And you will not find me buying long puts at a 40 to 30 VIX, guys. It's just you can be right on direction, but you may just not, the puts may not pay, because the volatility is just too high, right? If the market rallies and you buy puts there right? The volatility is going to get crushed. Then if you take puts, let's say you take puts on the SPY, yeah? You got to be very careful with this. They're very good for day trading, not so much for swing trading, yeah? Big rally, you'll buy puts here. The VIX will come down. You get another big drop, the VIX will skyrocket again. You may be right on direction, but your puts may not move. How many of you have faced that in recent times? You could try to swing trade SQQQ as well. Wait for the drops, then buy a whole batch of shares. But what are you going to do? Put the entire portfolio in SQQQ? Debatable, right? I don't know who's going to do that. Maybe some of you want to do that, but it's completely up to you, right? This is my strategy, up to you to determine your own. So hopefully that was helpful for all you guys. Hopefully today you liked today's video, even though it was very long, my longest video ever, but some of the craziest conditions we've ever seen on the channel together, right? So hopefully I'll be able to help you navigate throughout all the turmoil. That's it for me. If you enjoyed today's video, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing to the channel if you're new as well. We do these videos every Monday through Friday after the close, except for when we're on Fridays, I'm busy. Then I do them on the Saturdays. And thereafter, guys, if you have any questions, as always, please feel free to leave them down below, especially on the new strategy. Or if you want to call me out, whatever you want to do, you want to criticize me, I'm always open, guys. The best I can do is be transparent with you guys, explain the logic, be transparent, the wins, the losses, why it happened, so you guys can also have a learning experience from it all, right? If you expect every single person that's been following me or every single person in the Discord to be down as much as me, it's not the case. I had higher risk tolerance. I took the risk for the directional bets. It didn't play out. No problem at all. It doesn't affect me. The greatest thing you can do as a trader and an investor is just remove the emotions from all of it. Look at the cards on the table. Have your tool belt. If you're a trader, you have a tool belt with tons of strategies, and apply the strategy that applies to the current market conditions, right? There you go. That's everything I had for you guys today. Hopefully you enjoyed. I'll see you guys in tomorrow's top 5 options video with the bear market strategy version of the wheel overall. Thanks for watching, guys. Pleasure as always. Love you as always too. Hopefully you guys are doing well, and I'll see you soon. Take care and peace.